The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. Travel insurance policies are complex legal contracts with specific exclusions, limitations, and conditions that vary by provider and state of residency. We are not licensed insurance agents or brokers. You should conduct your own due diligence, read your specific policy documentation thoroughly, and consult with a qualified insurance professional or the underwriting company before making any purchasing decisions. Historical trends and case studies mentioned are for illustrative purposes and do not represent a potential outcome for every individual situation. Imagine you are standing at a boarding gate at JFK, 3 years of savings packed into a single suitcase, ready for a 14-day trek through the Swiss Alps or a luxury retreat in Maui. Now imagine a single phone call, a sudden fever, or a localized geopolitical shift renders that entire trip impossible. Within 60 seconds, $5,000 of non-refundable deposits simply vanish into the ether of corporate cancellation policies. Most Americans believe their credit card or their basic health insurance has their back in these moments. The reality is that for a significant portion of travelers, those safety nets are riddled with holes large enough to sink a middle-class retirement fund. In the next few minutes, we are going to dismantle the complex, jargon-heavy world of travel insurance to show you why the industry is built on the hope that you never actually read the fine print. We are revealing the specific mechanisms that insurance companies use to deny claims, and more importantly, how you can navigate those hurdles to ensure that if the worst happens, you aren't the one left holding the bill for a vacation you never took. The fundamental problem facing U.S. travelers today is a massive gap in literacy regarding covered reasons. Most people purchase a policy under the assumption that it acts as a universal safety net, a sort of get-out-of-jail-free card for any travel mishap. However, travel insurance is not a blanket of protection. It is a highly specific list of triggers. If your reason for cancellation or your specific medical emergency does not fit into a predefined bucket, the insurance company has no legal obligation to pay you a single cent. This deep dive masterclass is designed to solve that problem by providing you with a comprehensive framework to evaluate risk versus premium costs. We are going to explore the architecture of a standard policy, from trip cancellation and interruption to emergency medical evacuation, which is often the most misunderstood and potentially expensive component of international travel. Let's look at a case study involving a typical family from Ohio planning a trip to the Caribbean. They spent $6,000 on flights and a resort. They declined the internal insurance offered by the cruise line, thinking their premium travel credit card covered them. When a tropical storm was named 48 hours before departure, they tried to cancel. They quickly discovered that fear of travel, or bad weather forecasts, are almost never covered reasons unless the storm actually renders the airport or destination inaccessible. This is the distinction between perceived risk and contractual risk. Understanding this difference is the baseline for everything we will discuss. To truly understand travel insurance, we have to look at the three primary pillars of coverage. The first pillar is trip protection, which includes cancellation, interruption, and delay. The second pillar is medical and evacuation, which deals with your physical well-being while abroad. The third pillar is baggage and personal effects, which, while the most commonly discussed, is often the least financially impactful. For an American traveler, the stakes are uniquely high because the United States does not have a reciprocal healthcare agreement with most foreign nations. If you are a U.S. citizen and you break your leg in Italy or require an emergency appendectomy in Thailand, your domestic health insurance, including Medicare, often provides zero coverage or, at best, limited out-of-network reimbursement that requires you to pay the full cost upfront in cash. When we talk about trip cancellation, we are discussing the period from the moment you buy the policy until the moment you leave your front door. This is where the pre-existing condition waiver becomes the most critical piece of the puzzle. Most Americans don't realize that if they have seen a doctor for a specific ailment in the 60 to 180 days before buying insurance, any claim related to that ailment will be denied. However, there is a loophole. If you purchase your insurance within a look-back period, usually 10 to 21 days after making your initial trip deposit, many companies will waive that exclusion. If you miss that window by even 24 hours, you could be paying for a policy that is effectively useless for your specific health needs. Then we move into trip interruption. This is the nightmare scenario coverage. You are already in the middle of your trip, and something happens that requires you to go home early. Perhaps a family member back in the States is hospitalized, or you suffer an injury on day 3 of a 10-day tour. Trip interruption doesn't just cover the lost value of the remaining days. It often covers the exorbitant cost of a last-minute, one-way international flight home. Without this, a traveler might find themselves spending an additional $2,000 or $3,000 just to return to the U.S. during an emergency. We also have to address the cancel for any reason, or CFAR upgrade. This is the gold standard of travel flexibility, yet it is frequently misunderstood. CFAR is not a standard feature. It is a rider that typically increases your premium by 40 to 60%. While a standard policy might reimburse 100% of costs for a covered reason, like a documented illness, CFAR usually only reimburses 50 to 75% of your costs. But the trade-off is total sovereignty. If you simply decide you no longer feel like traveling, or if a global event makes you nervous but hasn't reached the level of a government-mandated travel ban, CFAR is the only mechanism that protects your investment. To put the importance of medical evacuation into perspective, consider the historical trends of medical transport costs. A private medevac flight from Mexico to a specialized trauma center in Houston can easily exceed $50,000. From a remote location in Asia or Africa, that number can climb to $150,000 or more. Standard health insurance plans rarely cover the repatriation of remains or the emergency medical airlift to a facility of the insurer's choosing. This is where the fine print becomes a matter of life and death, or at the very least, a matter of total financial ruin. Throughout this guide, we are going to break down the specific terminology you will encounter in a summary of benefits. We will explain the difference between primary and secondary coverage. If your travel insurance is secondary, you are required to file a claim with your personal health or home insurance first, receive a denial, and then submit that denial to the travel insurer. This process can take months and involves a mountain of paperwork. Primary coverage, on the other hand, pays out first, significantly reducing the bureaucratic friction during a crisis. By the end of this deep dive, you will possess the ability to read a policy quote like a professional underwriter. You will know exactly which boxes to check, which upgrades are marketing fluff, and how to time your purchase to maximize your legal protections. We are moving past the hope for the best strategy and moving into a calculated, data-driven approach to protecting your hard-earned vacations. This isn't just about saving a few $100s on a premium. It's about ensuring that the $5,000, $10,000, or $20,000 you've invested in your lifetime of memories doesn't vanish because of a single sentence hidden on page 42 of a policy binder. We are going to start by looking at the specific math of total trip cost and how most Americans overinsure or underinsure their journeys, starting with the very first deposit you lay down. To understand the math of the total trip cost, you have to look at your bank statement through the lens of an insurance adjuster. Most Americans, like a traveler named Mike from Chicago in 2026, make the mistake of insuring the entire sticker price of their vacation. Mike books a trip to Japan that costs $10,000. He sees that number and immediately enters $10,000 into a travel insurance quote engine. However, what Mike doesn't realize is that $3,000 of that cost consists of fully refundable boutique hotel deposits and flexible train passes. By insuring the refundable portion, Mike is essentially throwing premium dollars into a black hole. Insurance companies only reimburse non-refundable, prepaid expenses. If you can get your money back from the airline or the hotel provider directly, the insurance policy will not pay out a second time. This is the first rule of the masterclass. Audit your receipts. You must separate your sunk costs from your flexible costs. If your flight allows for a full refund to your original form of payment, that value should be subtracted from your insured trip cost. If your cruise has a graduated penalty scale where you only lose 25% of your deposit if you cancel 60 days out, your insurance needs change as you get closer to the departure date. Imagine if Mike had accurately calculated his non-refundable expenses as $7,000 instead of $10,000. He would have likely saved 20 to 30% on his premium costs while maintaining the exact same level of effective protection. This is a critical distinction because insurance premiums are typically calculated as a percentage of the total trip cost, usually ranging from 5 to 10%. On a high-end luxury trip, miscalculating this number by a few $1,000s can result in hundreds of dollars of wasted capital that could have been spent on the actual travel experience. However, the opposite error is even more dangerous. Underinsuring occurs when a traveler forgets to include the small, incremental costs that add up. Think about the non-refundable local tour guides, the prep-paid museum tickets, or the regional bush plane flights in remote areas. If you insure a trip for $5,000 but your actual non-refundable losses total $6,000, the insurance company will typically cap your reimbursement at the $5,000 limit you declared when you purchased the policy. In some cases, if the discrepancy is large enough, an adjuster might even question the validity of the entire claim based on an inaccurate declaration of trip value. The goal is a one-to-one match between your non-refundable paper trail and your policy limit. This leads us to the concept of the trip deposit date, which is the most overlooked variable in the American travel insurance market. In 2026, the industry standard dictates that many of the most valuable benefits, such as the pre-existing condition waiver or the cancel for any reason rider, are only available if the policy is purchased within a very narrow window following your first payment. Let's look at Sarah, a traveler from Austin. She paid a $200 deposit for a Mediterranean cruise in January for a trip taking place in September. She didn't plan to pay the full balance until June, so she waited until June to buy her travel insurance. When she went to purchase the policy, she discovered she was ineligible for the pre-existing condition waiver because she was 5 months past her initial deposit date. Even though she had only paid $200 in January, that transaction started the clock. In the eyes of the insurance company, the first dollar spent is the trigger. To avoid Sarah's mistake, you must treat the first deposit, no matter how small, as the official start of your insurance window. Even if you haven't booked your flights or finalized your itinerary, you can purchase a policy based on an estimated total cost and adjust that cost upward later as you add more bookings. This ensures that you lock in the time-sensitive legal protections that are vital if you or a family member has a medical history that could potentially flare up. Historical trends in claims data suggest that a significant percentage of denials for medical-related cancellations stem directly from travelers missing this 10 to 21-day window. Now let's dive deeper into the actual anatomy of a trip cancellation claim. This is where the terminology of covered reasons becomes a legal minefield. A covered reason is a specific event defined in the policy certificate that allows for a 100% reimbursement of non-refundable costs. Common covered reasons include the sudden death of a family member, a documented medical emergency involving the traveler or a traveling companion, or a primary residence becoming uninhabitable due to fire or flood. But consider the case study of David from Seattle. David booked a trip to the coast of Florida. 2 days before his flight, a major hurricane was projected to hit his destination. David canceled his trip out of safety concerns. His claim was denied. Why? Because the hurricane had not yet caused a mandatory evacuation of his specific hotel, nor had it shut down the airport for more than 24 consecutive hours. In 2026, many policies require that a natural disaster must actually prevent the travel from occurring, rather than just making the travel unpleasant or potentially risky. If the planes are still flying and the hotel is still standing, the insurance company expects you to show up. This is the gap where the cancel for any reason upgrade becomes essential. Without CFAR, you are at the mercy of the literal interpretation of the policy language. You are essentially betting that if a disaster happens, it will be catastrophic enough to trigger the legal definitions of the policy, but not so localized that it falls outside the coverage map. Furthermore, we must discuss the nuances of the work reason coverage. For many American professionals, a sudden change in work schedule is a primary risk. If your boss cancels your vacation or if you are required to work during your scheduled time off, a standard travel insurance policy will not cover you. You must specifically look for a policy that includes work reasons as a covered trigger. This usually requires a notarized letter from your employer and a history of previously approved time off. Even then, if you are self-employed or a business owner, these protections are often much harder to enforce. Case studies show that insurance adjusters look for any evidence that the work conflict was foreseeable. If there was a merger announced in your company 3 months before you bought the insurance, they may argue that the cancellation was a known risk rather than a sudden, unforeseen event. There is also the often ignored detail of the traveling companion definition. Most people assume a traveling companion is anyone they are going on a trip with. However, many policies define a traveling companion as someone who is sharing the same accommodations as you. If you are traveling with a group of friends but staying in separate hotel rooms, and your best friend has a medical emergency that causes them to cancel, you might not be covered to cancel your trip just because your friend can't go. You would be expected to travel alone or find a new companion. Understanding how your specific policy defines your inner circle is the difference between a synchronized group cancellation and one person getting a refund while the rest of the group loses thousands of dollars. As we peel back these layers, the complexity only increases when we cross international borders and enter the realm of medical emergencies. We have spent this time focusing on what happens before you leave, but the most significant financial risks actually begin the moment you step onto the aircraft. In the next section, we are going to expose the reality of international medical costs and the terrifying logistics of emergency evacuations. You will learn why the medical limit on your policy is often the least important number, and why the fine print regarding who chooses the hospital can change your life forever. We will also examine a specific case study of a traveler in 2026 who was stranded in a high-cost medical system, and the one sentence in their policy that saved them from a $200,000 debt. The specific case study involves a traveler named Robert from Denver who, in early 2026, suffered a severe cardiac event while visiting a remote mountainous region in Peru. Robert was a savvy traveler and had purchased a policy with a $100,000 medical limit, which he assumed was more than enough for a South American country where the cost of living is lower than in Colorado. However, the local clinic was unequipped to handle his condition, and the nearest cardiovascular center was in Lima, hundreds of miles away over difficult terrain. This is where the one sentence in his policy changed everything. The insurer will pay for transportation to the nearest adequate facility, as determined by our medical director. To the untrained eye, the word adequate sounds like a limitation. In reality, it is a legal trigger for one of the most expensive services in the world, the air ambulance. Because Robert's condition required specialized equipment and a pressurized cabin at a specific altitude, a standard commercial flight was impossible. The cost for a private medical jet, staffed with a flight nurse and a respiratory therapist, to transport him from the regional airstrip to Lima was $65,000. If the policy had specified the nearest hospital instead of the nearest adequate facility, the insurance company could have technically fulfilled their obligation by driving him to a local facility that lacked the necessary surgical suite, potentially resulting in a catastrophic medical outcome. Because of that single word, the $65,000 was covered as a transportation expense, preserving his $100,000 medical limit for the actual surgery and hospital stay in Lima. This distinction between emergency medical and emergency medical evacuation is the second pillar of our masterclass. Most Americans see two different dollar amounts on their policy quote. One might say $50,000 for medical and another might say $250,000 for evacuation. It is a common mistake to think these are the same thing. Emergency medical covers the doctors, the stitches, the x-rays, and the hospital bed. Emergency medical evacuation covers the logistics of getting you to those things. If you are on a cruise ship in the middle of the Atlantic and you need an emergency appendectomy, the evacuation coverage pays for the helicopter lift off the deck. Imagine if you are hiking in the Swiss Alps and you take a fall. Local mountain rescue services in Europe are highly efficient, but they are not free. A single helicopter dispatch can cost upwards of $20,000. If your policy only has a $10,000 limit for evacuation, you are personally responsible for the remaining balance before you even reach the hospital. In 2026, the historical trends show that medical inflation abroad is rising at a rate that outpaces domestic inflation in several popular U.S. tourist destinations. Consequently, a policy that was sufficient 5 years ago might leave a traveler significantly exposed today. Step by step, you need to evaluate your destination's infrastructure. If you are traveling to a major metropolitan area in a country with a high-quality, universal healthcare system, such as France or Japan, a medical limit of $50,000 might be sufficient for most incidents. However, if you are traveling to a developing nation or a remote island, you need a much higher limit specifically for the evacuation component. You aren't just paying for the medical care, you are paying for the fuel, the specialized pilots, and the international bureaucracy required to move a critically ill patient across borders. Another critical detail that Robert from Denver benefited from was the hospital of choice rider. Standard travel insurance policies give the insurance company the right to decide where you are treated and where you are evacuated. Their goal, naturally, is to get you to the nearest facility that can stabilize you at the lowest cost. If you are stabilized in Lima, but you want to fly back to your specialist in Denver for the actual recovery, a standard policy will not pay for that flight because you are already stabilized. A hospital of choice rider allows you to be transported back to a hospital in the United States once you are stable enough to fly, ensuring you are under the care of your own doctors and near your family. Without this specific language, you could be stuck in a foreign hospital for weeks during your recovery, with your family paying for hotels and meals out of pocket while they wait for you to be cleared for a standard commercial flight. let's look at the financial mechanics of how these claims are paid, which is where many Americans face their biggest shock. Most international hospitals do not recognize U.S. insurance cards. Even with a travel insurance policy, you might be expected to pay a significant deposit via credit card upon admission. This is where the distinction between primary and secondary coverage, which we touched on earlier, becomes a functional reality. If you have primary medical coverage, your travel insurer often works with a third-party assistance company that can issue a letter of guarantee to the hospital. This letter acts as a financial promise from the insurer to the hospital, often preventing the traveler from having to put a $20,000 charge on their personal visa. If your policy is secondary, or if the insurer does not provide a letter of guarantee, you are in a pay and claim situation. You pay the hospital, you collect every single itemized receipt, every doctor's note, and every discharge summary, and you submit them for reimbursement when you return to the U.S. For the average American, having $30,000 of liquidity available for an emergency is not always possible. This is why, when comparing policies in 2026, you should look specifically for companies that have a robust 24/7 assistance department with a proven track record of coordinating direct payments to foreign providers. Consider the case of a college student, Chloe, studying abroad in London. She suffered a severe allergic reaction and was rushed to the emergency room. Because she was in a country with a national health service, she thought it would be free. However, as a non-resident, she was billed at the private patient rate. Her travel insurance was secondary to her parents' US-based health plan. She had to wait 4 months for her US provider to officially deny the claim because it was out-of-network and international before the travel insurance company would even begin processing her reimbursement. This delay in capital can be a significant burden. Furthermore, we must address the dental emergency sublimit. It is usually a very small amount, often between $500 and $1,000. Most people ignore it until they bite down on a piece of hard bread in Italy and crack a molar. In 2026, dental work in major European cities is not inexpensive. If your policy has a $500 dental limit, it might cover the initial exam and a temporary fix, but the actual restorative work will likely come out of your pocket. It is a small detail, but it illustrates the granularity of these contracts. To maximize the value of your medical coverage, you must understand the concept of the acute onset of pre-existing conditions. This is different from the waiver we discussed earlier. If you have a known heart condition but it has been stable for years, and you suddenly have a heart attack, some policies will cover this as an acute onset. However, the definition of stable is extremely rigid. If you had your medication dosage adjusted even slightly 3 months before your trip, the insurance company may argue the condition was not stable, and therefore the onset was not acute, leading to a total denial of the claim. As we conclude this deep dive into the medical and evacuation pillars, it becomes clear that the value of the insurance is not in the payout itself, but in the coordination services. The people on the other end of the emergency phone line are the ones who find the English-speaking doctor, translate the medical records, and arrange the logistics of a flight that requires 3 seats removed for a stretcher. But what happens when the emergency isn't physical? What happens when your luggage, containing your laptop, your expensive camera gear, and your prescription medications, disappears into the baggage handling system and never comes back? Most people think they know how baggage insurance works, but the reality involves a complex system of depreciation, per item limits, and the difference between a lost bag and a delayed one. In the next part, we will break down the baggage myths and show you why your $5,000 camera might only be worth $500 in the eyes of an insurance adjuster, and how to fix that before you check your bags. The fundamental misunderstanding of baggage coverage starts with the difference between a baggage delay and a baggage loss. Most Americans in 2026 believe that if their suitcase doesn't show up on the carousel at Heathrow, they can immediately head to the nearest department store and charge a new wardrobe to their insurance provider. This is a myth that leads to thousands of denied claims every year. In reality, a baggage delay benefit typically has a time trigger, usually between 6 and 12 hours. If your bag arrives at hour 5, you are entitled to zero reimbursement for the change of clothes you bought. Furthermore, the benefit is usually capped at a modest amount, such as $200 per day, and it is strictly for essential items. If you buy a designer suit for a gala when a standard rental would have sufficed, the adjuster may deem the expense unnecessary. Now, let's look at the catastrophic scenario of total baggage loss through the case study of a traveler named Elena from Phoenix. Elena was headed to a photography workshop in Iceland in early 2026. She checked a high-end suitcase containing $5,000 worth of camera bodies, specialized lenses, and a high-performance laptop. When her bag was confirmed lost by the airline, she filed a claim for the full $5,000. She was shocked to receive a check for only $500. Why did this happen? It happened because of the specific limitation known as the per item cap and the secondary nature of baggage insurance. Most travel insurance policies have a total baggage limit, perhaps $3,000, but they also have a sublimit for electronics or jewelry, which is often capped at $500 in total for all such items combined. Furthermore, insurance adjusters apply depreciation. In the eyes of an insurance contract, a 2-year-old laptop is not worth what you paid for it. It is worth its current market value, which might be 40% of the original price. To protect yourself, you must look for a policy that offers replacement cost coverage rather than actual cash value, though these are increasingly rare in the standard consumer market. For someone like Elena, the solution wasn't in the travel insurance policy alone. She should have looked for a policy that allows for scheduled property, or used her homeowner's or renter's insurance as the primary coverage for her high-value gear. Historical trends in 2026 show that airlines are often legally capped by international treaties, like the Montreal Convention, which limits their liability to approximately $1,700 per passenger for lost luggage on international flights. If your gear is worth more than that, and you haven't read the per item caps in your travel insurance policy, you are essentially self-insuring the difference without realizing it. Imagine if you are traveling for a destination wedding. You have a $3,000 dress in your checked bag. If that bag is lost, and your policy has a per item limit of $500, you are facing a $2,500 loss. This is why the step-by-step rule for 2026 travelers is to never check anything that you cannot afford to lose, or that exceeds the per item cap of your policy. For everything else, you must maintain a digital inventory. You need photos of the contents of your bag, copies of the original receipts, and the property irregularity report from the airline. Without that specific piece of paper from the airline, your insurance claim is dead on arrival. Beyond the physical bags, we have to discuss the concept of travel delay coverage, which is the most frequently used benefit in the American market. In 2026, air traffic congestion and extreme weather patterns have made multi-hour delays a statistical probability rather than a possibility. If your flight is delayed for a covered reason, such as mechanical breakdown or weather, your policy can reimburse you for meals, hotel accommodations, and local transportation. However, the time trigger is again the gatekeeper. Most policies require a delay of at least 6, 12, or sometimes 24 hours before the benefits kick in. Consider the scenario of Marcus from Atlanta. His flight from New York to London was delayed by 8 hours due to a technical issue. Because he was stuck in the airport during the day, he spent $60 on meals and a lounge pass. His policy had an 8-hour trigger, so he was eligible for reimbursement. However, if that delay had only been 7 hours and 59 minutes, he would have been responsible for those costs himself. It is a game of minutes, and the insurance companies use the official airline flight logs to verify your claim. You cannot simply rely on your own watch. You need the official documentation from the airline carrier stating the exact duration and cause of the delay. There is also a hidden benefit within travel delay that many Americans overlook: the catch-up provision. If a delay causes you to miss your cruise embarkation or a prepaid tour, a high-quality policy will pay the necessary transportation costs to help you catch up to your trip at the next port or destination. This could mean a last-minute flight to the next island or a private car service to the next city. Without this, the cost of the delay isn't just a missed flight. It is the loss of the entire subsequent itinerary. But there is a catch that we must address. If your delay is caused by a strike, many policies will only cover you if the strike was not public knowledge at the time you purchased the policy. In 2026, with the rise of organized labor movements in the transportation sector, insurance adjusters are strictly vetting the dates of purchase against the dates of strike announcements in the news. If you bought your policy the day after a strike was threatened in the media, your claim for a strike-related delay will likely be denied because it was a foreseeable event. As we move through the complexities of baggage and delays, we must also confront the reality of personal liability and accidental death and dismemberment, or AD&D. While these are unpleasant topics, they are standard components of the American travel insurance package. Personal liability is crucial if you are staying in a vacation rental or participating in activities where you might accidentally cause property damage or bodily injury to someone else. For example, if you accidentally leave a faucet running in a luxury villa in Tuscany and cause $10,000 in water damage, your personal liability coverage is what prevents the property owner from suing you personally for the damages. Historical trends suggest that while baggage claims are the most frequent, liability claims are among the most expensive. Yet, many travelers skip the fine print on liability because they assume their US-based umbrella policy covers them worldwide. While that may be true for some, many domestic policies have territorial exclusions that leave you vulnerable once you clear customs. Step by step, when you are evaluating the third pillar of your insurance, you should ask 3 questions. Does this policy cover my items at replacement cost or depreciated value? What is the specific dollar limit for a single item? And does the travel delay benefit cover the cost of catching up to a missed connection or just a hotel stay? These answers determine whether you have a functional safety net or just a piece of paper that makes you feel better. However, even the best baggage and delay coverage won't help you if you are engaging in what the insurance industry calls excluded activities. In 2026, the definition of what constitutes a risky activity has shifted. You might be surprised to find that something as common as renting a scooter in Bali or going on a guided scuba dive can void your entire policy if you don't have the right adventure sports rider. In the next part, we are going to dive into the world of exclusions, the specific reasons insurance companies use to walk away from a claim, and the hidden activities that most Americans don't realize are considered high risk. We will look at why a single glass of wine at dinner could potentially lead to a denied medical claim, and how to ensure your sense of adventure doesn't lead to financial catastrophe. To understand the world of exclusions, we have to look at the legal language regarding intoxication and risky behavior, which is the most common trap for American travelers in 2026. Imagine a traveler named Jordan from Nashville, who is vacationing in the Greek islands. Jordan has a nice dinner, enjoys 2 glasses of local wine, and while walking back to his hotel, trips on an uneven cobblestone street and breaks his wrist. He goes to the local clinic, submits his claim, and is stunned when it is denied. The insurance company points to a clause in the policy that excludes coverage for any injury sustained while under the influence of an intoxicating substance. In the world of insurance underwriting, the definition of under the influence is often left intentionally vague or tied to local legal limits. In some jurisdictions, having any measurable amount of alcohol in your system can be used as grounds to deny a medical claim, regardless of whether the alcohol actually caused the accident. Historical trends in 2026 show that adjusters are increasingly requesting toxicology reports from hospital records when a nighttime injury occurs. This means that your $500 emergency room visit or your $50,000 surgery could become your personal financial responsibility simply because you had a drink with dinner. The step-by-step takeaway for any traveler is to read the specific alcohol exclusion in your policy. Some policies use the phrase to the extent that it contributes to the loss, which offers more protection, while others use a blanket exclusion for any loss occurring while intoxicated. Beyond the dinner table, we have the adventure sports exclusion. Most Americans assume that if a tour is sold by a reputable company or a cruise line, it must be safe and therefore covered by insurance. This is a dangerous assumption. Consider the case of Taylor from Seattle, who went on a guided scuba diving excursion in Belize. Taylor is a certified diver, but her policy had a fine print exclusion for any underwater activity involving breathing apparatus. When she suffered a mild case of decompression sickness and required a hyperbaric chamber, the $600 bill was denied. In 2026, the list of excluded activities has expanded. Standard policies often exclude bungee jumping, skydiving, hang gliding, and even certain types of trekking. If you are hiking at an elevation above 15,000 feet, many standard policies classify that as mountaineering rather than hiking, which triggers a total exclusion of medical and evacuation benefits. If you are planning a trip to the Himalayas or even high-altitude sections of the Andes, you must purchase a specific adventure sports rider. This rider acts as a bridge, specifically naming the activities you plan to pursue. Without it, you are essentially traveling without medical insurance the moment you strap on a harness or a tank. We must also address the rental car damage exclusion. Many Americans rely on their primary auto insurance or their credit card for rental car coverage abroad. However, in 2026, many domestic U.S. auto policies do not extend coverage outside of the United States and Canada. Furthermore, the coverage provided by credit cards is often secondary and comes with a list of excluded countries, such as Ireland, Israel, or Italy. If you rely on your travel insurance policy for rental car protection, you must verify that it includes a collision damage waiver, or CDW. Even then, the travel insurance CDW usually only covers damage to the vehicle itself, not third-party liability. If you hit another car in a foreign country, your travel insurance might pay for the dent in your bumper, but it won't pay for the other person's medical bills or car repairs unless you have a separate liability policy. Let's look at the illegal acts exclusion through the lens of a traveler named Alex from Boston. Alex is in a country where certain over-the-counter medications from the US are classified as controlled substances. He is stopped at a checkpoint, and because he doesn't have a specific type of translated medical authorization, he is detained and his trip is interrupted. His insurance claim for the lost days of his trip is denied because the event was triggered by an illegal act, even if the act was unintentional or based on a misunderstanding of local law. In 2026, insurance companies are strictly enforcing the rule that ignorance of the law is not a covered reason for a claim. Another massive exclusion category involves foreseeable events. This is where the timing of your policy purchase becomes a legal battleground. Imagine if a major airline announces a pilot strike is looming. If you buy your insurance the day after that news breaks, any delay or cancellation caused by that strike is considered a foreseeable event and is excluded from coverage. The same applies to named tropical storms. Once a storm is named by a meteorological organization, it is a known entity. You cannot buy insurance to protect against a storm that is already on the map. This underscores why the only effective strategy in 2026 is to purchase your insurance the same day you book your first flight or hotel. We also need to discuss the mental and nervous disorders exclusion. For many years, travel insurance almost universally excluded any claim related to anxiety, depression, or other mental health conditions. While some modern policies in 2026 have begun to offer limited coverage for acute mental health crises, the majority still maintain strict exclusions. If a traveler has to cancel a trip because of a severe depressive episode or a panic disorder, they may find that their claim is denied unless they have the cancel for any reason upgrade. The policy sees a physical broken leg as a valid reason, but a mental health emergency is often viewed as a non-covered event. Consider the scenario of a family trip to an area experiencing civil unrest. If the U.S. State Department issues a Level 4, do not travel advisory after you book your trip, a standard policy might allow you to cancel. However, if the advisory was already at a Level 3 or 4 when you purchased the policy, the insurance company will argue that the risk was foreseeable and refuse the claim. In 2026, the volatility of global events means that travelers must monitor the State Department's website as closely as they monitor their flight status. There is also the professional athletics exclusion. If you are traveling to participate in a marathon, a cycling race, or a local soccer tournament where there is any form of prize money or professional sponsorship involved, your standard travel insurance is likely void during the event. You are viewed as a professional risk rather than a recreational traveler. This even applies to collegiate athletes traveling for competition. Specialized sports travel insurance is required to fill this gap. Step by step, you should perform an exclusion audit on your policy before you pay the premium. Look for the section titled General Exclusions. You are looking for keywords like participation in, resulting from, or due to. If you see a list of 20 activities and your favorite hobby is on that list, the policy is essentially a hollow shell for your specific needs. You are better off paying $20 more for a policy that explicitly covers your lifestyle than saving $20 on a policy that will inevitably deny your claim. But even if you have the perfect policy with no exclusions, you still have to navigate the actual claims process. This is the stage where most people fail, not because they weren't covered, but because they didn't have the right paperwork. The burden of proof is entirely on the traveler. In the next part, we are going to walk through the claims master map, the exact folder of documents you need to build while you are still on your trip to ensure your claim is approved on the first try. We will look at why a simple photo of a doctor's business card isn't enough, and the specific document you must get from an airline before you leave the airport terminal if your flight is delayed. If you think the insurance company will take your word for it, you are in for a very expensive surprise. The surprise begins at the gate. Consider a traveler named Kevin from Boston in early 2026. Kevin is standing at the desk of a major carrier after his flight to Rome has been delayed for 14 hours due to a mechanical failure. Kevin does what most modern travelers do. He takes a photo of the departure board showing the delay and saves a screenshot of the notification from the airline's app. He assumes this is his proof. However, when Kevin returns to the United States and files his claim for the $200 he spent on a hotel and meals during that delay, his claim is promptly denied. The insurance adjuster informs him that a screenshot is not a legal verification of cause. To the insurance company, a photo of a screen is easily manipulated and lacks the official endorsement required to move money from their coffers to his bank account. This is the first rule of the claims master map. You must secure a statement of delay before you leave the airport terminal. In 2026, many airlines have automated this process, but you cannot assume it will be emailed to you. You must approach the gate agent or the customer service desk and specifically request a written statement on airline letterhead that details the flight number, the original departure time, the actual departure time, and most importantly, the specific reason for the delay. Was it weather? Was it a mechanical issue? Was it a crew timing out? If the reason is not a covered reason under your specific policy, the documentation will at least allow you to know that immediately, rather than waiting weeks for a denial. If the agent tells you they cannot provide it, you must ask for the supervisor. This document is the bedrock of your claim. Without it, you are simply a person who stayed in a hotel by choice in the eyes of the law. Moving from the airport to the hospital, we encounter an even more rigorous set of requirements. Imagine if a traveler named Maria from San Diego suffers a severe case of food poisoning in Mexico City. She spends a night in a private clinic, pays $1,200 on her credit card, and receives a receipt. When she files her claim, it is denied. Why? Because Maria provided a receipt for payment, but she did not provide a clinical narrative. A receipt proves that money changed hands, but it does not prove why. In 2026, insurance companies require an itemized medical bill and the attending physician's notes. These notes must include the date of the first consultation, the symptoms reported, the diagnosis, and a specific statement that the condition was an emergency that necessitated immediate treatment or rendered the patient unfit to travel. Step by step, if you are hospitalized abroad, you must act as your own paralegal. Before you are discharged, you must ensure you have a copy of your entire medical file from that stay. This includes laboratory results, X-rays, and the discharge summary. If the documents are in a foreign language, do not worry about translating them yourself yet. The insurance company has specialized departments for this. However, you must have the originals. If you leave the hospital without these, trying to obtain them from 3,000 miles away once you are back in the US is a logistical nightmare that often results in the claim being closed due to lack of information. Historical trends in 2026 show that claims with a complete clinical narrative are processed 60% faster than those relying solely on credit card statements. Next, we must address the hygiene of your financial receipts. When you are in the middle of a travel delay or a baggage loss, it is easy to lose track of small slips of paper. However, the difference between a total of $400 in reimbursement and zero is often found in the itemization. If you go to a restaurant during a 12-hour delay, and the receipt only shows a total of $45, the insurance company may deny the claim because they cannot verify if the expense included alcohol, which is almost universally excluded from delay coverage. You must keep the itemized receipt that shows exactly what was ordered. Furthermore, in 2026, many insurance companies are requiring proof of the original form of payment. This means you should keep your credit card statements that show the corresponding charges. If you pay in cash, you are often at a disadvantage because there is no secondary digital trail to verify the transaction date and time. For baggage claims, the documentation requirement is even more specific. If your bag is lost or damaged, you must obtain a Property Irregularity Report, or PIR, before you leave the baggage claim area. If you take your bag home and discover the frame is bent or the contents are missing, and you report it 24 hours later, the insurance company will likely argue that the damage could have happened after you left the airport. The PIR is a unique serial number tied to your claim in the airline's global tracking system. It is the only evidence an insurance company will accept to prove the airline was in possession of your bag when the loss occurred. If your bag is delayed, you must also keep the baggage tags that were affixed to your suitcase. These contain the barcodes that track the bag's movement through every sorting facility in the world. Once you have gathered your statement of delay, your clinical narrative, your itemized receipts, and your PIR, you face the central document, the proof of loss form. This is the formal application for reimbursement. In 2026, most insurers have moved this to a digital portal, but the questions remain trap-laden. One of the most common mistakes is the failure to disclose other insurance. The form will ask if you have coverage through a credit card or a primary health provider. If you say no, and the insurance company discovers you do, they may deny the claim for material misrepresentation. You must be transparent. The travel insurance company will then coordinate with your other providers to determine who pays first, a process known as coordination of benefits. Consider the case of a traveler who ignores the timeline. Most policies have a strict statute of limitations for filing a claim, often ranging from 60 to 90 days from the date of the loss. If you wait 4 months to get your paperwork together, your claim is legally dead. You must initiate the claim as soon as the event occurs, even if you don't have all the documents yet. This puts the insurer on notice and creates a placeholder in their system. What happens if you follow every step, provide every document, and they still say no? In 2026, the appeal process is your final line of defense. An initial denial is often generated by an automated system or a junior adjuster following a rigid checklist. An appeal triggers a review by a senior adjuster. Your appeal letter should not be emotional. It should be a clinical cross-reference of your policy's language against the evidence you provided. If the policy says it covers delays due to mechanical failure, and your airline letter says mechanical failure, and they still denied you, your appeal should simply point to those two facts. Historical trends show that a well-documented appeal has a significant potential outcome of reversal. But before you ever get to the point of filing a claim, you have to make the most important decision of the entire process. Where do you actually buy the policy? Not all insurance is created equal. In the next part, we are going to expose the massive differences between the insurance offered by airlines during checkout, the coverage hidden in your premium credit cards, and the specialized policies found on independent comparison sites. We will look at why the one-click insurance at the bottom of your flight booking is often the most expensive and least effective way to protect your trip, and the specific 2026 credit card traps that leave travelers stranded with zero coverage. The convenience of the checkbox at the bottom of a flight checkout screen is the most expensive trap in the modern travel industry. Consider a traveler named Brian from Austin in 2026. Brian is booking a $2,000 flight to Tokyo. At the final payment screen, a small window appears asking if he would like to protect his trip for a mere $39. Seems like a no-brainer. Brian clicks the box, feeling a sense of security. However, what Brian actually bought was a limited benefit policy designed for the airline's liability, not his personal risk. Historical trends show that these embedded policies often have medical limits as low as $10,000 and narrow cancellation windows that only cover the flight itself, leaving Brian's $5,000 non-refundable hotel and his $3,000 guided tour of Kyoto completely exposed. In 2026, the airline is not an insurance broker. They are an affiliate marketer earning a massive commission on a product that is often insufficient for a deep-dive international trip. Now let's compare Brian's situation to Jessica from Florida. Jessica is a premium credit card holder. She pays a $500 annual fee for a card that touts world-class travel protection. She assumes she is the smartest traveler in the room because she is getting her insurance for free. But Jessica is about to hit the 2026 credit card trap. In recent years, major credit card issuers have aggressively tightened the language in their guide to benefits. The first hurdle Jessica faces is the full fare requirement. In 2026, many premium cards will only activate their insurance benefits if the entire cost of the trip, every single dollar of the airfare, hotel, and tours, is charged to that specific card. If Jessica used her card for the flight but used a different card for the hotel to maximize points, her insurance might be completely voided for the entire journey. Furthermore, we must look at the secondary coverage trap. Most credit card travel insurance is secondary to any other insurance you have. If Jessica has a medical emergency in France, she cannot simply call her credit card company and expect them to wire money to the hospital. She must first file a claim with her primary health insurance in the US, wait for the inevitable denial because she was out of network and out of the country, and then submit that denial to the credit card's third-party claims administrator. Case studies from 2026 show that this process can take 6 to 9 months to resolve. While Jessica is waiting for her reimbursement, she is the one carrying the balance on her credit card at a 24% interest rate. Imagine if Jessica had a medical evacuation scenario. While her premium card might offer an evacuation benefit, the limit is often capped at $100,000. As we discussed earlier, an evacuation from a remote area or a specialized medical flight back to the United States can easily exceed that amount. If the cost is $150,000, Jessica is personally liable for the $50,000 gap. This is the danger of relying on a benefit that was designed as a marketing perk, rather than a dedicated insurance product. This brings us to the third option: independent travel insurance marketplaces. These are sites where you can compare dozens of policies from different providers. This is where a traveler named Mark from Chicago found his solution in 2026. Mark spent the same $39 that Brian spent at the airline checkout, but because he used an independent marketplace, he was able to filter for a policy that offered primary medical coverage and a $500,000 evacuation limit. By stepping outside the airline's ecosystem, Mark gained 10 times the coverage for the exact same price. The step-by-step process for evaluating these three options starts with a benefit audit. First, look at your credit card's current guide to benefits. In 2026, you cannot rely on what the card covered in 2024. Look specifically for the phrase common carrier. Many cards have restricted their coverage to only apply while you are a passenger on a plane, train, or bus. If you fall and break your leg while walking to a museum, your credit card might offer zero medical coverage because you weren't on a common carrier at the moment of the injury. Independent policies, conversely, cover you from the moment you leave your house until the moment you return, regardless of your mode of transport. Second, examine the definition of family. In 2026, credit card policies often have a very narrow definition of who is covered. It might only include you, your spouse, and your dependent children. If you are traveling with an elderly parent or a sibling, they are likely not covered under your credit card's policy, even if you paid for their flight with your card. Independent policies allow you to list every person on the itinerary as an insured traveler, ensuring that a medical emergency for one person doesn't result in a financial disaster for the whole group. Third, look at the 2026 exclusion for digital and cyber disruptions. This is a new development in the insurance world. With the increase in global IT outages and cyber attacks on transportation infrastructure, many airline-offered policies have added specific exclusions for delays caused by software failures or cyber events. However, certain high-tier independent policies have introduced riders that specifically cover these modern risks. If the global booking system goes down and you are stranded for 3 days, the airline insurance might call it an act of God and deny the claim, while a specialized independent policy will cover your hotel and meals. Another critical factor is the 24/7 assistance team. When you buy insurance from an airline, the assistance is often outsourced to a massive generic call center. When you use a premium credit card, you are often dealing with the bank's concierge, who then transfers you to an insurance underwriter. Independent insurance companies, however, often have dedicated, in-house medical assistance teams staffed by people who specialize in international logistics. In a crisis, you don't want a bank teller. You want a medical coordinator who knows how to talk to a doctor in Tokyo at 3 in the morning. To maximize your potential outcome, you should use a credit card for the initial purchase to get the baseline protection, but then layer on a primary independent policy to fill the gaps. This is known as layering. It ensures that if the claim is small, you can use the card's benefits, but if the claim is a catastrophic medical event, you have the high limits and primary status of a dedicated policy. Historical trends indicate that travelers who layer their coverage have a much higher success rate in recovering their total trip investment compared to those who rely on a single source of protection. As we move forward in this masterclass, we have to look at the most specialized and often most expensive form of travel: the cruise. The cruise industry has its own unique set of insurance rules, and the policy the cruise line tries to sell you during booking is perhaps the most complex and potentially restrictive contract in the entire travel world. In the next part, we are going to dive into the cruise ship trap. We will look at why a ship being forced to skip a port is almost never a covered reason for a refund, and the specific medical reality of being treated in a ship's infirmary versus a land-based hospital. We will also examine a 2026 case study of a family whose dream vacation was ruined by a missed connection, and why their cruise line insurance was completely useless in helping them catch the ship. The Miller family from Columbus, Ohio, represents the textbook definition of why the cruise ship trap is so devastating for American travelers in 2026. David and Sarah Miller, along with their 2 teenage children, had invested $15,000 into a spring break voyage through the Southern Caribbean. Like many travelers, they purchased the cruise line protection plan offered during the digital checkout process. They believed that because the insurance was branded by the cruise line itself, it would offer the most seamless integration with their itinerary. However, in March 2026, a sudden ground stop at John Glenn Columbus International Airport, due to a localized cybersecurity protocol, meant their flight to Fort Lauderdale was delayed by 9 hours. By the time the Millers reached the pier, The ship had already cleared the harbor. When David Miller contacted the assistance hotline, he discovered the first major flaw in cruise-branded policies: the airfare gap. Because the Millers had booked their flights independently to save money on points, the cruise line's insurance policy treated the flight delay as an external event. The policy's missed connection benefit had a time trigger of 12 hours. Since their delay was only 9 hours, the insurance company legally classified the event as a missed departure due to personal logistics rather than a covered interruption. Historical trends show that independent travel insurance policies frequently have missed connection triggers as low as 3 to 6 hours, which would have allowed the Millers to claim the costs of flying to the first port of call in Aruba to meet the ship. Instead, the Millers were forced to pay $4,000 out of pocket for last-minute international flights and hotel stays, just to salvage the final 4 days of their 7-day vacation. Furthermore, the Millers encountered the voucher versus cash dilemma. When they attempted to claim the value of the 3 days of the cruise they missed, they were informed that the cruise line protection plan only offered reimbursement in the form of future cruise credits. In 2026, this is a standard practice for many internal cruise line plans. They do not give you your money back. They give you a coupon for a future trip that must be used within 12 months. For a family that can only travel during specific school breaks, this voucher was nearly worthless. An independent travel insurance policy, by contrast, would have potentially provided a cash reimbursement for the prorated cost of those missed days, deposited directly into their bank account. The second layer of the cruise ship trap involves the shipboard medical reality. Imagine if Sarah Miller had fallen ill while the ship was between islands. On a cruise ship, the medical facility is technically a private clinic operating in international waters. In 2026, the doctors on board are almost always independent contractors, and the equipment available is limited to stabilization rather than long-term care. If a passenger requires serious medical attention, the ship's primary goal is to offload that passenger at the next available port. Case studies from 2026 indicate that being offloaded in a foreign port can lead to a financial nightmare. If you are dropped off in a small port in the Grenadines, the local hospital may not have the capacity to treat a complex cardiac or neurological event. You would then require an emergency medical evacuation to a facility in Puerto Rico or the mainland United States. Most cruise line insurance plans have medical evacuation limits that are shockingly low, often capped at $25,000 or $50,000. In 2026, the cost of a private medical jet with an intensive care team flying from the Caribbean to Miami is historically between $75,000 and $120,000. Without an independent policy that offers a $500,000 or $1 million evacuation limit, a traveler could be left with a life-altering debt before they even reach a U.S. hospital. You must check the specific evacuation limit on your policy summary. If it is under $100,000, you are essentially self-insuring the most expensive part of a medical crisis. Another area of confusion for Americans is the skipped port benefit. In 2026, as cruise lines move toward more environmentally conscious and fuel-efficient routing, it is becoming increasingly common for ships to skip a scheduled port of call due to high winds, sea conditions, or technical adjustments. Many travelers believe that if they miss a port they were looking forward to, their insurance should compensate them for the disappointment. The reality is much colder. Standard travel insurance policies only pay a small, fixed amount for a missed port, typically between $50 and $100 per person, and only if the port was missed due to a covered reason like weather or mechanical failure. This benefit is designed to cover the lost value of a prepaid shore excursion, not to refund the cost of the cruise itself. If the cruise line changes the itinerary for any reason, they are legally protected by the contract of carriage you signed when you booked, which states they can change the route at their discretion without providing a refund. We must also look at the financial default coverage. In 2026, while the major cruise lines are stable, many boutique or regional cruise operators face fluctuating fuel costs and regulatory pressures. If you book a cruise and the company goes bankrupt before you sail, a cruise line-provided policy will almost never cover you because the policy is issued by the very company that just went belly up. Independent travel insurance often includes a financial default clause, which protects your investment if the travel provider ceases operations. This is a critical safety net for anyone booking with smaller, high-end expedition cruise lines. Step by step, if you are planning a cruise in 2026, you should follow this logic. First, check if your airfare is covered by the policy. If you booked your own flights, you almost certainly need an independent policy with a low missed connection trigger. Second, look at the medical evacuation limit and ensure it is at least $250,000 for international itineraries. Third, verify whether the reimbursement for a cancellation is in cash or vouchers. If you see the words future travel credit in the policy summary, you are not buying insurance. You are buying a restricted store credit. Finally, there is the issue of quarantine and confinement. In 2026, cruise ships have strict health protocols. If you or your cabin mate tests positive for a communicable illness, the ship's captain has the authority to confine you to your stateroom for the remainder of the voyage. Most cruise line policies will only reimburse you for those lost days if you have a specific benefit for trip interruption due to quarantine. Without it, you could spend 5 days of your vacation staring at a cabin wall while paying full price for the experience. As we navigate the complexities of specific travel types like cruises, a broader question arises for the frequent traveler. If you are taking more than 2 or 3 trips a year, is it better to buy a new policy every time? Or is there a way to protect your entire year of travel with a single contract? Most Americans are unaware that there is a specific type of insurance designed for the mobile lifestyle of 2026. In the next part, we will break down the math of annual versus single-trip policies. We will look at why an annual policy might be the ultimate hack for the digital nomad or the business traveler, and the one hidden limit in annual plans that could leave your most expensive luxury vacation completely unprotected if you aren't careful. To understand the hidden limit in annual plans, we first have to look at the math of the frequent traveler. In 2026, the rise of the remote work economy has created a new class of American traveler, the digital nomad or the business leisure hybrid. Consider the case study of Tyler, a freelance software architect based in San Francisco. In a typical year, Tyler takes 12 separate trips, 6 for client meetings in cities like New York and Austin, for weekend getaways to national parks, and 2 major international vacations to places like Portugal and Vietnam. If Tyler were to buy a single-trip policy for every one of these journeys, he would be filling out 12 different applications and likely spending between $1,500 and $2,000 in total premiums. Instead, Tyler opts for an annual multi-trip policy, which costs him a flat fee of approximately $500 for the entire year. On the surface, Tyler's strategy seems like the ultimate financial hack. For $500, he is covered from January 1st to December 31st for every trip he takes, provided each trip starts and ends at his primary residence. However, Tyler is about to encounter the most dangerous fine print in the 2026 insurance market: the aggregate trip cancellation limit. Most annual policies are designed for the high-frequency, low-cost traveler. They often come with a per-trip cancellation limit of only $3,000 or $5,000. Imagine if Tyler decides to splurge on a $15,000 luxury safari in South Africa for his 10th anniversary. He assumes that since he has his annual policy, his investment is protected. But when a sudden medical emergency forces him to cancel the safari, he discovers that his annual policy will only reimburse him up to the $5,000 cap stated in his contract. He is effectively out $10,000. This is the distinction between a convenience product and a protection product. Annual plans are excellent for covering medical emergencies, baggage delays, and small flight interruptions across many trips, but they are historically insufficient for protecting high-value, once-in-a-lifetime vacations. To achieve a positive potential outcome, a traveler like Tyler must supplement his annual plan with a specific single-trip top-off policy for his high-cost journeys, or simply accept the risk on the balance. The second hidden hurdle in annual plans is the consecutive day limit. In 2026, many insurance providers have tightened their definitions of what constitutes a trip. An annual policy does not cover you for a 365-day journey. It covers an unlimited number of trips, but each trip must be shorter than a specific duration, typically 30, 60, or 90 days. Consider Chloe, a digital nomad from Seattle who decided to spend 4 months working from a co-living space in Medellin, Colombia. On day 95 of her stay, she contracted a severe respiratory infection and required hospitalization. Because she had exceeded the 90-day consecutive limit of her annual policy, her coverage had technically expired 5 days prior. The insurance company denied the claim in its entirety, leaving Chloe with a $12,000 hospital bill. Step by step, if you are a long-term traveler, you must cross-reference your itinerary against the maximum trip length of your annual plan. If you are planning to stay abroad for 6 months, an annual multi-trip policy is the wrong product. You instead need what the industry calls long-stay or nomad insurance, which is priced differently and specifically allows for extended durations. Historical trends in 2026 show that as more Americans work from abroad, the number of denied claims due to exceeded trip lengths has increased by nearly 40%. Adjusters are now using digital passport stamps and airline boarding records to verify the exact date you left the United States. Beyond the limits, we must discuss the domestic travel benefit, which is the most undervalued feature of annual plans for the average American. Most people think of travel insurance as an international-only necessity. However, a high-quality annual policy covers you for any trip more than 100 miles away from your home. Imagine you are driving from Chicago to a wedding in Nashville. If your rental car is totaled in a multi-car pileup in Indiana, or if your expensive suit is stolen from the trunk of your car at a rest stop, your annual travel insurance can act as your primary coverage. In 2026, with the increasing costs of domestic car rentals and the rise in highway congestion, having an annual policy that includes a collision damage waiver for rental cars can save a traveler hundreds of dollars in daily insurance fees at the rental counter. Furthermore, we need to address the pre-existing condition waiver in the context of annual coverage. As we discussed earlier, single-trip policies require you to buy the insurance within a narrow window of your first deposit. With an annual policy, the rules are different. In 2026, many annual plans will cover pre-existing conditions as long as you are stable and fit to travel on the day you purchase the annual policy and at the time you book each individual trip. This creates a much more flexible environment for travelers with chronic health issues. However, the definition of stable remains a legal battleground. If you changed your blood pressure medication 2 weeks before your annual policy renewed, and then had a heart-related event during a trip 3 months later, the insurer might argue the condition was not stable during the look-back period of the renewal. Let's look at the business equipment rider, which is essential for the 2026 professional. Standard single-trip policies often treat a laptop as a personal effect, subject to that $500 per item cap we discussed. For Tyler or Chloe, whose professional lives depend on a $4,000 MacBook Pro and specialized hardware, that cap is a disaster. High-tier annual policies often allow for a business equipment upgrade, which raises the limit for professional tools and covers the cost of renting replacement equipment if yours is lost or stolen while you are on the road. This ensures that a baggage mishap doesn't just ruin your vacation, but also prevents you from losing your income. Another critical factor is the renewal trap. In 2026, many annual policies are set to auto-renew. While this ensures you never have a gap in coverage, it also means you might miss the notification that the underwriter has changed the terms of the policy. Between 2025 and 2026, several major U.S. insurers adjusted their epidemic and pandemic language, moving from broad coverage to highly specific triggers. If you allow your policy to auto-renew without reading the updated summary of benefits, you might be carrying a policy that no longer covers the specific risks you are most concerned about. As we weigh the pros and cons of annual versus single-trip coverage, it becomes clear that there is no one-size-fits-all solution. The goal is to match the policy's architecture to your specific movement patterns. For the person taking one big trip a year, the single-trip policy is the surgical tool of choice. For the person living a life of constant motion, the annual policy is the essential utility. But even with the right policy in hand, you still need to know how to navigate the final hurdle: the purchase itself. In the final part of this masterclass, we are going to pull everything together into the ultimate 2026 travel insurance buying checklist. We will reveal the 3 specific questions you must ask the insurance representative before you hit the buy button, and the one trick companies use to hide the most important exclusion in the entire document. We will also examine the future of the industry, including AI-driven claims processing, and how to ensure you aren't being discriminated against by an algorithm. This is the moment where we turn all this theory into a practical, repeatable strategy for every trip you take for the rest of your life. If you want to ensure that your travel budget stays in your pocket and not in the insurance company's profits, you cannot afford to miss the final conclusion. The transition from theory to execution happens at the moment you receive your policy certificate. In 2026, many Americans make the mistake of assuming the confirmation email is the final word. It is not. The confirmation is just the receipt. The certificate is the law. To ensure you are not falling into a trap, you must perform the 48-hour audit. Most travel insurance policies sold in the United States include a free look period, typically between 10 and 15 days. During this window, you can cancel the policy for a full refund if you find the terms are not what you expected. This is your leverage. Imagine a traveler named Jason from New Jersey who is planning a high-stakes trip to the fjords of Norway. Jason has spent $12,000 on a specialized photography cruise. He receives his policy and immediately looks for the 3 essential questions. The first question he asks the representative or verifies in the text is, does this policy cover my specific itinerary including every prepaid, non-refundable deposit I have made to date? Jason discovers that while his cruise is covered, the 3-day pre-cruise hotel stay he booked through a third-party site was not included in the initial quote because he forgot to add it to the total trip cost. If he cancels, he would lose that $2,000 hotel deposit. The step-by-step fix is to call the insurer within the free look period and adjust the total insured amount. Historical trends show that travelers who adjust their policies during the free look period have a much higher rate of total loss recovery than those who wait until a claim is filed. The second question Jason asks is this medical coverage primary or secondary, and what is the specific procedure for a letter of guarantee? In 2026, this is the single most important operational detail. If the insurer cannot issue a letter of guarantee, Jason would be required to pay for any medical emergency out of pocket and wait months for reimbursement. By confirming the primary status and the guarantee protocol up front, Jason ensures that if he suffers an injury in a remote Norwegian village, the insurance company's assistance team will communicate directly with the clinic to handle the billing. The third question is the most technical. Does the evacuation benefit allow for bed-to-bed transportation to a hospital near my home, or only to the nearest adequate facility? As we discussed in earlier parts, the difference between being stabilized in a foreign city and being flown back to New Jersey is a specific clause in the contract. If the policy only covers transportation to the nearest adequate facility, Jason might find himself stuck in an Oslo hospital for 3 weeks of recovery, away from his family and his own doctors. If the policy includes a hospital of choice or bed-to-bed rider, the insurer is contractually obligated to move him back to the U.S. once he is stable enough for flight. Now we must expose the most sophisticated trick used by insurance underwriters in 2026, the definition trap. Most people skip the definitions section of a policy, assuming that words mean what they mean in plain English. However, in the world of insurance, a word like travel or injury might have a highly restricted meaning. For example, some 2026 policies define a trip as travel to a destination at least 100 miles away from your primary residence. If Jason's flight to Norway departs from an airport only 50 miles away, and he suffers a delay or a baggage theft at that airport, the insurance company could argue that the trip had not yet technically begun according to the policy's internal definition. You must verify that the definition of a trip aligns with your actual movements, especially if you live in a major metropolitan hub where your departure point is close to home. We also have to address the rise of AI-driven claims processing. In 2026, the first person to review your insurance claim is not a person at all. It is a machine learning algorithm designed to scan for red flags. These algorithms are programmed to look for patterns of fraud, but they can also lead to automated denials for legitimate claims that lack specific metadata. To navigate this, you must ensure your documentation is digital first. When you take a photo of a medical receipt or a delay statement, you must ensure the GPS coordinates and the timestamp are embedded in the image file. If the AI sees a receipt from a pharmacy in Rome but the metadata says the photo was taken 3 weeks later in New Jersey, it may flag the claim for manual review, delaying your payment by months. Historical trends in 2026 suggest that claims submitted with verified metadata are processed in as little as 48 hours, whereas paper-based or unverified claims can take up to 90 days. Furthermore, there is the issue of algorithmic discrimination. In 2026, some insurers use predictive modeling to adjust premiums or coverage limits based on the perceived stability of a specific region or the historical claim rates of certain demographics. While this is a controversial practice, it is a reality of the modern market. To protect yourself, you should always get quotes from at least 3 different underwriters. If one company is charging significantly more for the same coverage, it is likely because their algorithm has flagged your destination or your itinerary as high risk. By diversifying your search, you can find the underwriter whose risk model is more favorable to your specific situation. Consider a case study of a traveler named Emily from Chicago who was using a new, app-based insurance provider. Emily filed a claim for a stolen laptop while in Spain. The AI denied her claim within minutes, citing a lack of forced entry evidence in her police report. Emily didn't give up. She knew that in 2026, every automated denial must have an appeal path to a human adjuster. She resubmitted her claim with a detailed narrative explaining that the theft occurred via a common distraction technique used by pickpockets, which under her policy's specific language for theft, was a covered event. This human review resulted in a reversal and a full payout. The takeaway is clear. The AI is a gatekeeper, but the contract is your key. If the AI says no, you must demand a human audit. The final strategy for the 2026 traveler is the digital vault. Before you leave the United States, you must have a secure, cloud-based folder containing 4 things: a PDF of your full policy certificate, a photo of your initial trip deposits and receipts, a copy of your passport and ID, and the 24/7 international collect call number for your insurance assistance team. You should also share this folder with a trusted person back home who is not traveling with you. If you are incapacitated, that person becomes your advocate, capable of initiating the evacuation process on your behalf. As we conclude this deep dive masterclass, remember that travel insurance is not a luxury. It is a sophisticated financial instrument designed to mitigate the inherent risks of global movement. It is the difference between a minor inconvenience and a life-altering financial disaster. By moving past the marketing slogans and diving into the fine print, you have transitioned from a passive consumer to an informed traveler. You now know how to calculate your true trip cost, how to timing your purchase to lock in waivers, how to document a claim like a professional, and how to navigate the complexities of 2026 technology. But even with the best insurance, there is one more layer of protection that no policy can buy: the knowledge of what to do in the first 60 minutes of a global emergency. While insurance pays the bills, your survival and safety depend on your immediate actions on the ground. To complete your preparation for the world of 2026, you need to understand the global emergency response protocols that exist outside of your insurance policy. In our next deep dive series, we will examine the U.S. State Department STEP program, the reality of consular assistance, and the secret protocols for navigating civil unrest in a foreign country. If you think the embassy will just fly a plane in to pick you up, you are about to see a very different side of international diplomacy. We will see you in the next masterclass.